I'm joined by Richard from online mortgage broker Habito, and he's going to answer a number of questions that Money to the Masses podcast listeners and readers have sent in. And I've got a few questions of my own that I want to put to you, Richard. So I'm going to start with a few general things about the mortgage market. If you could give us some insight, it'd be great. So one of the things that people are very interested in at the moment is about how affordability testing has changed, if it has at all, over the last year or so, because obviously we're in a cost of living crisis, and people who might be thinking about remortgaging this year, of course there are millions of people that have got to do it, then they are obviously worried about affordability. So has that changed? What are you seeing when you're obviously advising clients and putting applications through?
So a lot of people understandably are shocked about what their new mortgage rate is going to be. And also some lenders have also changed how much they can lend out slightly, because what a lot of people aren't aware of is lenders actually calculate how much they'll lend out based on the potential future rate changes. Okay, so they're not necessarily lending out on what rates are at the moment. So what's happened is, since rates have gone up quite considerably over the last few months, it's sort of exceeded what they were previously modelling their affordability calculations on. So now those calculations are actually based on the even higher rates of what rates could be in the future, or what they could get to. So they're basing it on what happens if it gets even worse. So what people can borrow now might not be what they could have borrowed, say, 6 months to 12 months ago.
So what about in terms of some of the assumptions they have? So obviously they are going to be assumptions when they look at people's personal finances, their actual spending. They will look at their the evidence they will send in, and maybe it'll be bank statements, etc. So are you seeing more or more harsh assumptions, particularly around things like energy bills, or whether it'll be things about spending, discretionary spend? Is that changed?
Discretionary spending, not so much. So in their own calculations, so a lot of lenders use Office of National Statistics data, and naturally there's been an increase in, say, energy bills. So they will be modelling in the background, which you can't see, slightly higher costings, which relate to that.
Okay. And so are you seeing people, because obviously you will have clients that you would have done a remortgage for, got them a fixed deal, for example, say 2 years ago, and then they're going to be part of that wave of people who are going to be remortgaging this year. Are they facing a shock, not just about the rate they could get, but about the options for them in terms of remortgaging? Because although their earnings might not have increased as quickly as, say, they would have hoped, but of course the cost of living has caused bills, etc., to go up. Are you seeing people in a situation where their options are worse than they were 2 years ago? I'm just trying to give people a picture of what they're likely to encounter if they are going to be remortgaging this year compared to where they were, say, 2 years ago.
Yeah, unfortunately so. And that's going to be, for the vast majority of people, it's going to be worse than what it could have got a couple of years ago. So a couple of years ago, we're talking about rates close to sort of 1% for deals, whereas now you're lucky, very lucky, to get lower than 4% out there in the market. So unfortunately, for a lot of those people remortgaging from a couple of years ago, even 5 years back, who are coming up for renewal, their rates and monthly payments aren't going to be what they'd like, unfortunately.
But are people having options still? Because what I'm thinking about, are people now remortgaging and finding that the number of the opportunities that companies they could remortgage to is going to be less because of some of the affordability, because of the cost of living, than it was, say, a few years ago? Is that the case, or are there still plenty of options for people? Because I know a lot of people are worried. Is there still a hope for them, or are people actually more people doing product transfers now than they were previously?
So I'd say a lot more people are doing product transfers. However, they're not aware that there's still loads of options out there available for them. So it is important to speak to brokers to get the best possible deal, because not necessarily sticking with your current lender is going to be the best option. If you do that, whilst it might be easier to do, it's going to potentially cost you money in the long run. So it is important to remember that there are going to be options available for for the vast majority of people. And a lot of the time, even though the monthly payment might be going up, you're still going to get full reign of the whole mortgage market. And if you're just borrowing the same amount as before, it's very likely that you're going to be able to still have free reign of the mortgage market. So um, rest assured, people can still speak to a broker and get full options out there.
So, especially as you say, if they're not looking to borrow any more money, then they've got that wide range of options, including the product transfer option, where they can just move to a new product with their existing lender. One thing I'm interested is that obviously after the mini budget that we had in September, which was a complete disaster and it caused that spike in mortgage rates and deals to be pulled rapidly. What are we seeing now in terms of the number of deals that are out there? And rates seem to be settling around the sort of 4% level, don't they? Particularly on like 5-year fixes. But are the number of deals that are available out there increasing? Are they stabilizing, or are they being pulled quickly? So when they're actually the best buyers on the tables that we see out there, are they being pulled very quickly? People have to move fast to get them. So what is that dynamic that's going on?
So it has started to stabilise a little bit. The short notice sort of withdrawals aren't as common as they were, say, a few months ago, which is good news. A lot of lenders also did withdraw certain deals as well, but things are starting to open up more where lenders are actually offering their full suite of products for people. So it is a good time to actually start looking to remortgage and actually securing a deal because things have certainly settled down in the market.
Okay. And one of the things that I'm also interested in is the time it's taking now to remortgage. Given the sort of volume of people that are needing to remortgage and what's been going on in the market, is the time that it's taking for the whole remortgage process to go through, is that still the same as it was before? How long is that at the moment?
So if you're switching to a new lender, give yourself a couple of months or so. Gives time for the lender to get their mortgage offer out, which can take obviously every lender is different, so a couple of weeks or so, 2 to 3 weeks to get that mortgage offer out. And then there's going to be legal work on top of that where the solicitor needs to do their own thing. Timescales in that haven't really changed too drastically, to be perfectly honest. So as long as you're given a fair bit of time, like I said, a couple of months or so, then you're going to be absolutely fine to get that secured in time.
So we've all seen headlines about property prices and the crash that's going to happen in property prices. No one's got a crystal ball that can actually predict the future, but there are a lot of headlines around it. So whether it's new borrowers or it's to do with remortgaging, are you seeing an impact on the valuations that are being given by lenders on potential properties? So are you seeing down valuations, more of them and stuff like that? What's going on in that part of the mortgage market?
So when it comes to remortgaging, not so much because since people have had their properties, the property price has gone up a lot more than people may have anticipated. And then even if it has come down a little bit, what they think it's worth is going to be in that right ballpark for a lot of lenders. So it's not really much of an issue, to be honest. With purchases, it's maybe a few more, not drastically more than it was before. However, it's still early stages in the grand scheme of things when it comes to these trends in the property market. So that could be something in the future, down valuations, which could impact things. So it is important when you speak to a broker, if there is a down valuation with one lender, another lender actually might value it at the price you think it's worth. So when you do speak to a broker, they can switch that application over to a different lender who uses different valuation companies, and they might come back with a more preferential valuation for yourself.
Okay, so I'm going to switch on to some of the questions that we've been sent in, and this one relates to higher interest rate payments. But they're saying mortgage rates mean monthly payments are going to be considerably higher. How easy is it to move onto an interest-only mortgage?
So with interest-only mortgages, there's extra criteria that you do need to pass with lenders. So initially, most lenders, not all, they do have minimum income requirements, which is far higher than the national average salary. The other requirement is with a lot of lenders is they've got a minimum amount of equity that you hold in the property. So that could be a percentage equity that you hold and or pound value that you hold. If you do not pass those, you do also have the option to actually split your mortgage onto interest only and capital and interest. So you could have half the mortgage for example, 50% of the property value on interest only, and then the rest of it, if it's above 50% loan to value, on capital and interest to actually meet those requirements that the lender does have. So when you do speak to a broker, they're going to have full access to different lenders for you, and they'll be able to actually talk through your options and ensure that if you did want to go interest only, you do fit a certain lender's criteria. You might not fit one, but you could fit in others.
So that leads on quite nicely to the next question, actually, about splitting a mortgage. So this person is obviously trying to hedge their bets when it comes to interest rates and whether they go up or down. So they've asked, is it possible to have part of your mortgage as a fixed rate mortgage and then actually have part of it on a variable rate or tracker rate?
Yes, so that's possible with a number of lenders. So some people do this because, say, the tracker might not have early repayment charges. And other reasons people might do that is they might have a lump sum that might be due in a few years' time, but they might want to down pay a large portion of their mortgage quickly without penalty. So that's another reason why someone might want to do a fixed and a tracker on their current mortgage.
Are both of them, do they have to both be with the same lender though?
Yes, absolutely. That's the main thing. So you can only have one mortgage lender per property.
So that will obviously then start to restrict the rate that you might get. So that's going to influence what you might end up with. You're not necessarily going to have the best of both worlds in terms of the best fixed rate or tracker rate out there.
Yeah, that's absolutely right. So it's important when you speak to a broker that they look at both options for yourself. But the vast majority of people, it's either going to be a fixed or a tracker for the whole mortgage balance that's going to be best for them. So it's really sort of niche examples where you take both.
Mentioning interest only always makes me think straight away of buy to let. Are we seeing harsher criteria from lenders in regards to buy to let? Is there a sort of withdrawal of products? Because I've seen a lot in the press about buy to let landlords coming under pressure.
Yeah, absolutely. So the affordability is actually a lot more impactful in terms of the buy-to-let market at the moment, because previously that's always been more based on the actual rate itself rather than people's personal income. So now a lot more people cannot get the amount of mortgage they need on the buy-to-let that they actually want when they do come to remortgage or even purchase a new property. So the amount they're borrowing is a lot less. So we've had a lot of people who actually remortgaging are having to do product transfers because other lenders will not lend the mortgage that they need. And because it's been on interest only, because that balance just has been staying the same over the last few years and not coming down like most residential mortgages would have been, they're stuck with that same lender.
So the next question I've got is around somebody who's remortgaging, who's clearly got some money aside in the bank, and they're asking whether it would actually be a good idea and whether they can just to pay down a chunk before they remortgage. So what are their options?
Can definitely look to make an overpayment when you do come to remortgage, and you've got a couple of options with this. So if you do switch lenders, you can simply apply for a lower mortgage amount than needed, and then the solicitor that's actually handing the remortgage will then request a lump sum outstanding from you to then pay off your previous lender. For example, if your current mortgage is £120,000, with the new lender you can apply for £100,000, and when you come to complete, the solicitor will request that £20,000 to pay off your previous lender. Alternatively, if you're doing a product transfer and sticking with your current lender, some do waive over repayment restrictions in the final month where you won't be penalised to make a large overpayment. So if you do this, please ensure you speak to your current broker to actually confirm that you wouldn't actually incur this penalty.
Okay, so that is also presumably quite useful then, that they may be able to lower their loan to value if they were going to be looking to remortgage as well. They may be able to get some access to better deals. On that, for somebody who might have money in the bank, are you seeing a lot more people looking to take out offset mortgages?
Yeah, so a lot of people now at the moment are looking to offset their deals, and a few more are speaking to us about that kind of scenario. What people do need to remember is there's fewer offset options out there than if you just had non-offset. So you could be paying actually more on your mortgage overall if you weren't actually going to offset at all. So it's important you speak to your broker and get all your options available and speak to a financial advisor, because it's important to make the most of your money at the moment.
Okay, for those people who don't know what an offset mortgage is, could you give them a quick overview of what it is and how it works?
So an offset mortgage is when you actually open a savings account alongside the mortgage itself. And then if you have any large sum of money lying about, you can actually put that into that savings account, which is linked to that mortgage. So it's important to note that the offset savings account is open at the same time as the mortgage itself. So it will be with the savings account will be with the same provider as the mortgage. So the money that's actually sitting in that account will offset the balance of the mortgage. And that means that it will reduce the balance that interest is charged against on the mortgage. So, for example, if you had a £100,000 mortgage and you had £50,000 sitting in that offset savings account, the mortgage lender will only charge interest against the remaining £50,000 that's not offset on the mortgage. And this means that you could pay back less interest overall.
Okay, and presumably the other benefit there then is that offset happens without tax being applied to people who are high taxpayers. That offset happens means that there is actually essentially a tax saving there because you get taxed on your savings if you've got that interest in your high interest rate taxpayer. We'll obviously put links in the notes of these videos so people can read a bit more about offset mortgages. Quickly, discount mortgages. Are you seeing a lot of people do discounts or more people interested in discount mortgages?
Yeah, a lot of people are coming through and asking about discount variable rates. Often these are with smaller building societies, as say your larger lenders typically have tracker mortgages. So it's important to note with discount variable rates are linked to specific lender variable rates rather than say the Bank of England base rate. So that lender can change their own variable rate, which then means you're paying back more interest on your mortgage in the future. More people are coming through with that because they're seeing them on price comparison sites a lot, and they're often coming up as the cheapest deal available, but people don't fully understand what that actually means. So it's important to speak to your broker about what the discount could mean in the future.
So on that, just briefly explain why they show up as the cheapest, because the way a discount mortgage works is very particular, isn't it? So if you could just run through that quickly, that would be great.
So how discount variable rates work is it's a discount off the actual lender's variable rate. So if that's 7% of the lender's variable rate, and they might be charging a offset of minus 3.5%, which will give an initial rate of 3.5%, which is excellent in this current environment. And that's why it's going to be sourcing higher when you're looking on price comparison websites. However, a lot of people don't understand is when the lender, or if the lender, increases their own standard variable rate, that means your own mortgage payment, if you do take that deal, is going to go up. And the lender can do that at any point.
Yeah, so the discount is obviously where the name comes from. You get a discount from that variable rate that then reduces. In your example, you had 7%. It was a discount of 3.5, got you to that 3.5. Right, I'm just going to finish up then on the $1 million question. We have lots of people writing and saying, should I fix? Should I get a tracker? What's going to happen with rates? And of course, we can't give advice. But what would be interesting is just to get your insight into how the market has changed in terms of what people are ending up with when they are advised and what they come to you asking for compared, say now, compared to where we were a year or so ago.
So a year or so ago, because rates were so low, a lot of people were mainly coming through asking for fixed deals, unless they really wanted a deal without early repayment charges. If they might be moving home, they might have gone for a tracker. Now, because when the mini budget happened, tracker deals were actually a lot better than fixed deals. And so a lot of people did go for trackers or other variable deals when that did happen. What we've seen though, after over the last few weeks, is that gap's actually shrunk. Well, actually, fixed deals recently have actually been reducing, even though the Bank of England base rate has been going up. So when the Bank of England base rate has been going up, the actual variable deals haven't actually been going up, but then the fixed rates have actually been coming down in that period of time. So the gap between the two is very minimal now. So in the last couple of weeks or so, probably a lot more people now looking at the fixed options. And the other thing that's very different from a year or so ago is actually the longer term fixeds actually have initial lower rates than the shorter term fixeds. So previously you'd be seeing a lot of the 2-year fixed would have been the cheapest deals. Now it's the sort of the 5 and the 10-year fixed deals, which are actually lower rates than 2 and the 3-year fixed deals.
So that's obviously a reflection of where people are, or the market is projecting that base rates could potentially be in the future. So thanks for your insights, Richard. I'd just like to thank you for coming on the show. For anybody who is listening to this, you can go onto Money to Masses website. You can see our Best Buy mortgage table, which is actually powered by Habito. You can compare different deals over there, and so you can see some of those movements in the best buys on those tables. Of course, if you need advice, then make sure you go and seek the help of an independent mortgage advisor, one such as Habito. And although we do talk about rates on the in this particular episode, do bear in mind there are lots of other factors that go into the recommendations that you'll be given to actually the mortgage you end up taking out. And Richard sort of alluded to some of those there. Well, they'll be down to what you actually plan to do in the future, whether it's moving, etc. So there's a lot of reasons why you need to get advice rather than just focusing on the interest rate. So Richard, thank you for coming on, and I really appreciate it.
Thanks for having me.